So imagine you're reading a company's quarterly scorecard,
Okay, I'm with you.
and their core product, growth like specifically their loan originations, is up an incredible 60%.
Wow.
Yeah. And revenue, that's up 40%.
Those are massive numbers.
Right. But then you look a little closer,
Yeah.
and short-term profit actually dropped.
Ah, there's the catch.
Exactly. I mean, for most traditional companies, that combination is just an immediate red flag. It totally breaks the fundamental rule we're all taught in business, which is, you sell more product, you make more profit.
Right, because when Wall Street analysts see massive top-line growth coupled with a dip in profitability, the instincts, the immediate assumption is that the company is basically just buying revenue.
Like slashing prices or something.
Exactly, or, spending recklessly on marketing just to juice the numbers for the quarter.
But for the AI lending platform Upstart, we're going to find out why this specific financial paradox is actually a highly calculated weapon.
It completely flips the traditional narrative.
It really does. So welcome to today's deep dive. We are taking a look right under the hood of Upstart, and we're pulling directly from the unvarnished transcript of their Q1 2026 earnings call Q&A.
The fun part.
Yeah, exactly. Our mission here is to sort of strip away all that executive corporate speak. We want to understand the actual mechanics of their aggressive reinvestment playbook.
Which is fascinating, by the way.
Right. And we'll dissect a massive pivot into a brand new product category and figure out what their proprietary AI models are secretly telling us about the real financial health of everyday people.
And for those of you listening, keep in mind, this isn't just a simple spreadsheet review. Earnings call Q&As are where the polished PR script ends and the real tension begins.
Oh, totally. The analysts do not hold back.
No, they don't. So what we have here is a real-time look at a major fintech navigating basically the ultimate corporate tightrope.
Managing Wall Street's expectations.
Exactly. Managing that relentless pressure for immediate quarterly profits while trying to make the expensive structural investments required to build an empire for the next decade.
So let's start right there with that glaring paradox from the very top of the call. Loans are up 60%. Revenue is up 40%. But the bottom line takes a hit due to operating expenses.
Right.
Now, the management team used a very specific phrase to defend this. They called it a capital-efficient reinvestment framework.
Of course it did.
Right, classic corporate phrasing.
Yeah.
But they also reaffirmed their annual guidance. So they're still targeting $294 million in adjusted EBITDA, which is essentially their cash flow from operations before any accounting maneuvers.
Yeah.
And they expect a return to net profitability later. But my question is, how does a profitability dip fit into a capital-efficient strategy? I mean, it's kind of like, think of a highly successful restaurant, right?
Yeah.
It's packed every single night. The food is flying out of the kitchen. But their current bank account looks lower because they're taking all that cash and pouring it into building a massive extension out back.
That's a really good analogy, actually.
So is this a reckless gamble or a calculated strategy?
It's definitely calculated, and it comes down to understanding unit economics and, well, where the cash is actually flowing.
Okay, break that down for us.
So Upstart has mature segments of their core personal loan business that are just highly optimized. These segments generate very high contribution margins.
Meaning what exactly?
Meaning, after the direct costs of originating those specific loans, there is a lot of profit left over, like a lot.
Okay.
A company optimizing for a single quarterly earnings report would just let that cash drop to the bottom line, take a bow, and, enjoy a temporary bump in the stock price.
Right. Keep the shareholders happy today.
Exactly. But they aren't doing that. They are intentionally rerouting that cash flow.
So they're taking those high margins from the mature products and just immediately funneling them into acquiring market share in newer areas.
Yes. Because mathematically, in the lending platform space, capturing a highly qualified borrower today and retaining them in your ecosystem, that compounds over years.
Oh, I see.
Upstart is looking at the math and realizing that the lifetime value of expanding their footprint right now far outweighs the short-term applause they get for just hoarding the Q1 cash.
It's like, for anyone listening, sometimes in your own life or career, you have to take a short-term hit, right? Like paying for an expensive new certification or taking a course because you know it's going to guarantee long-term compounding growth.
That's exactly it. You're investing in your future capacity.
But isn't there a massive risk in doing that for a company this size? You're essentially betting that today's expensive customer acquisition is going to pay off in a macroeconomic environment that is, frankly, pretty unpredictable right now.
Well, sure, there's always risk. But that risk is mitigated by the AI model itself. Upstart isn't just blanket spending on, like, Super Bowl ads hoping for the best.
Right, it's on a spray and pray approach.
Not at all. They are reinvesting the capital specifically into channels where their AI has identified mispriced risk.
Mispriced risk. So borrowers who are actually prime quality, but might be overlooked by traditional FICO scores.
Exactly. The AI finds that arbitrage opportunity, and when it does, the most capital-efficient thing you can do is spend whatever it takes to acquire that borrower before a legacy bank catches on.
Okay, so if they are intentionally sacrificing Q1 profits to capture new market share, where exactly is that cash burning? Because if you're going to take a hit on your bottom line to fuel growth, it better be a structural pivot, right? Not just a temporary marketing push.
Right.
And reading through the transcript, that brings us to the big product reveal.
The launch of Cashline.
Yes, Cashline. So Upstart is introducing a revolving credit product, which for a company built on term loans is a big deal.
It's a huge shift. I mean, with a term loan, you borrow a lump sum, you pay it back over a fixed schedule, and the transaction is basically done.
Right.
Moving into revolving credit is a completely different operational beast. It's daily engagement. It's essentially an alternative to a traditional credit card.
It changes the entire relationship with the borrower.
Exactly.
Yeah.
A term loan is transactional. Revolving credit is sticky.
Sticky, meaning they stay around.
Yeah. If a consumer has a credit limit they can draw from, pay down, and draw from, again, Upstart is suddenly integrated into their weekly, sometimes even daily financial life. That dramatically increases the lifetime value of that customer we were just talking about.
I have to push back on this strategy, though.
Okay, let's hear it.
The revolving credit space is notoriously cutthroat. I mean, you are going head-to-head with massive legacy banks. Chase, Citi, Capital One.
Giants.
Absolute giants. Institutions with endless balance sheets, decades of behavioral data, and massive, lucrative rewards programs. Furthermore, building a revolving credit engine requires immense upfront capital.
It does.
If Upstart's AI gets the risk modeling wrong on day one, they are on the hook for massive losses before they can even blink. Why step into that arena?
Because the legacy banks are still largely relying on traditional credit scoring systems to approve those credit cards.
Right, the old FICO system.
Yeah. Upstart's wedge into this highly competitive market is their AI's ability to identify what we call the hidden prime borrower.
Okay, what does that look like in practice?
Well, millions of consumers are rejected for premium credit cards because of, say, a thin credit file or maybe a minor historical ding. But they might have strong current cash flows, solid employment, high education variables, which Upstart's models weigh heavily.
So they aren't trying to steal the Chase Sapphire customer.
No.
They are pricing the risk for the person Chase rejected, but who the AI knows is actually a safe bet.
Precisely. And to address the upfront capital risk you mentioned earlier, Upstart's management is very aware of that exposure. Their strategy here is incredibly pragmatic.
How so?
Well, they aren't trying to fund this massive revolving credit expansion off their own balance sheet permanently. Management actually noted this was possibly their best day one product launch in company history, but the goal right now is purely to prove the product's scale and risk-adjusted returns.
Meaning they basically eat the initial cost to build this statistical proof.
Yes. Once the AI proves it can accurately manage the dynamic day-to-day risk of a revolving credit line at scale, that performance data will naturally attract third-party capital partners.
So institutional investors will look at the yield, see the AI's accuracy,
Yeah.
and come in to take over the funding.
Right. Upstart builds the engine, takes the initial test drive risk, and then lets institutional capital pay for the gas once the safety rating is established.
That transition to third-party capital partners is actually the perfect pivot to the next major theme of this earnings call.
Let's get into it.
We're talking about needing institutional partners to eventually fund Cashline. But how are they funding that massive 60% growth in their core personal loans right now? Like, where is the capital actually coming from to fuel that 40% revenue jump?
To understand that, we have to look at what is arguably Upstart's most crucial hidden asset, the performance of their funding engine.
Okay.
In the lending business, loyalty doesn't exist. Institutional capital flows strictly to wherever it can get the best, most reliable, risk-adjusted returns.
Right, money talks.
Exactly.
Yeah.
And Upstart revealed a staggering data point to the analysts on this call. Their credit performance has consistently beaten Treasury spreads for 12 straight quarters.
Wow. Let's translate that for a second for you listening.
Yeah.
When management says they've beaten Treasury spreads, they mean the gap between what investors could make just sitting safely in U.S. government bonds,
Yes.
which is the ultimate risk-free baseline, right?
Yes.
Versus the yield they get by investing in Upstart's loans.
And doing that for 12 straight quarters means they have outperformed the risk-free baseline through 3 full years of severe macroeconomic weirdness.
Yeah, weirdness is a good word for it.
We are talking about a period that included aggressive interest rate hikes, inflation spikes, and those regional banking panics.
Silicon Valley Bank, all of that.
Exactly. Through all of that volatility, the AI priced the risk accurately enough to deliver premium returns to their partners.
Well, that explains why the transcript mentions they secured over $4 billion in additional funding capacity just this year. Capital isn't just trickling in, it's flocking to them.
It really is.
But the structure of that funding stood out to me even more than the dollar amount. They signed their first ever 24-month committed capital deal.
Yes, that is huge.
I mean, in a market where investors usually demand 30-day or 90-day out clauses so they can, pull their money at the first sign of a recession, getting an institution to lock their money in for 2 full years is a massive flex.
It changes the entire risk profile of the company.
I look at it less like a fixed-rate mortgage and more like a massive power purchase agreement for a data center.
Oh, interesting.
Yeah. Upstart is essentially locking in the exact cost and supply of the electricity needed to run their lending engine for 2 full years. They're making themselves immune to sudden grid spikes or energy shortages.
That is a much more accurate way to look at it, actually, because it is fundamentally about guaranteeing operational liquidity.
Right.
Upstart is a software and AI company, right? They have absolute control over their code, their user interface, their underwriting algorithms. But the one variable they cannot control is the macroeconomic climate.
Nobody can.
Right. So if a sudden shock hits the economy tomorrow and traditional banks freeze their lending, which happens constantly in downturns, Upstart's engine doesn't shut down.
Because that 24-month capital is legally committed to keeping the lights on. It allows management to completely ignore the daily panic at the financial gas station.
It allows them to underwrite loans through a downturn when their competitors are forced to pull back. And historically, the loans originated during the early stages of an economic recovery, when competitors are still terrified, end up being the most profitable vintages.
Really?
Oh, yeah. So securing long-term capital ensures Upstart is fully armed to capture that market share when others retreat.
Okay, so securing $4 billion and locking in 2-year agreements is obviously a massive vote of institutional confidence.
Definitely.
But I have to bring us back down to reality for a minute, because the analysts on this call were definitely sweating over the messier parts of the balance sheet.
As they always do.
Right. If we look at the specific expenses that drove that short-term profitability dip, the transcript points to spikes in sales and marketing, S&M, and general and administrative costs, G&A.
Yeah.
When an investor sees those exploding while profits drop, the immediate fear is institutional bloat.
And the analysts pressed them hard on this during the Q&A. But management's breakdown of those expenses was incredibly mundane. Yeah, the Q1 expense spike was largely a product of corporate calendar seasonality, not a permanent structural flaw.
Meaning things that only happen once a year just happen to hit the books all at once.
Exactly. The first quarter is traditionally when annual payroll and benefits resets occur, annual bonuses pay out, compensation bands are adjusted across the entire company, and payroll taxes hit their annual limits. That creates an isolated, natural inflation of costs. And on top of that, the administrative spike was heavily driven by an all-hands company meeting held in Q1.
Oh, sure. You fly your remote workforce in, rent the venue, cover the hotels, the logistics. All of that lands as a localized hit on the Q1 income statement. It's an event, not a new baseline operating cost.
Exactly. And furthermore, management explicitly clarified that there were no material costs from their ongoing bank charter application hitting the books this quarter.
Because sometimes regulatory pursuits could be a huge hidden drain on resources, right?
Yes, very often. But they confirmed that wasn't dragging down the numbers, and they expect operating expense growth to moderate significantly for the rest of the year.
Well, that certainly makes the expense side look less alarming. But let's talk about the risk side, specifically the balance sheet itself. The transcript notes their total balance sheet hovered around $1 billion.
Yep.
In the lending world, having $1 billion of loans sitting on your own books instead of being sold off to those third-party partners makes people nervous.
It does. It raises flags.
It leads directly to questions about risk sharing, which, for you listening, is the concept where institutional investors demand that Upstart keeps some of their own money in the loans they originate.
Basically keeping skin in the game.
Right, so that if the loans default, Upstart bleeds alongside the investor. So are the capital partners starting to squeeze Upstart to take on more of the downside risk?
It is a totally valid concern, especially when you're securing $4 billion in a tight market. You
Right.
sort of assume the investors extracted heavy concessions to hand over that much cash. But management's answers revealed the opposite trend, actually. Because of those 12 straight quarters of outperforming treasury spreads, Upstart's negotiating power has increased.
Oh, wow.
Yeah, the risk-sharing terms have remained highly consistent, and in several newly negotiated deals, the terms actually improved in Upstart's favor.
So they aren't being forced to warehouse bad loans just to secure funding.
No, not at all. The co-investment they do make is a tiny, calculated fraction of their total funding, and the capital they deploy there actually generates very strong, healthy returns for their own balance sheet.
Okay, so what about that $1 billion total balance sheet figure then?
Management explained it is largely a function of plumbing.
Plumbing, as in just the mechanics of how the money moves.
Yes, it's
Yeah.
a timing fluctuation. It's based on the settlement dates of when loans are aggregated and sold off to partners. To demonstrate that the pipes are flowing smoothly, management highlighted that a noticeably higher percentage of their auto and home equity loans were sold directly to third parties in Q1 compared to the end of last year.
So the machinery of originating a loan and quickly offloading it to institutional capital is functioning exactly as designed.
Precisely.
Which brings us to the ultimate foundation of this entire operation. We can talk about capital efficiency, revolving credit pivots, 24-month funding lockups, and balance sheet plumbing all day.
We really could.
But here's the undeniable truth. None of these brilliant financial mechanics mean anything if the everyday person borrowing the money cannot pay it back.
True.
At the end of the day, a $4 billion war chest just evaporates if consumer defaults spike. So what is Upstart actually seeing for the people on the ground?
This was perhaps the most fascinating divergence from the mainstream narrative in the entire earnings call.
I thought so too.
Upstart introduced their proprietary metric, the Upstart Macro Index, or the UMI. And according to the UMI data, the U.S. consumer has been broadly stable since late last year.
Broadly stable. I mean, that almost sounds like a parallel universe. If you turn on any financial news network or read the morning headlines, the narrative is that the consumer is completely tapped out, credit card debt is spiraling, and the economy is constantly teetering on the edge of a cliff.
Right.
How can Upstart's AI look at the exact same macroeconomic landscape and conclude that everything is fundamentally stable?
The divergence exists because traditional financial media and government indicators are largely looking at lagging data.
Okay, like what?
Things like traditional FICO score aggregates, monthly jobs reports, or the Consumer Price Index, these tell you what happened last month or last quarter. Upstart's AI, on the other hand, is evaluating high-frequency, real-time variables.
Like actual bank account cash flows, employment verification, and daily repayment velocities across millions of active loans.
Exactly. Upstart operates on a strict model-first philosophy. They don't react to terrifying news headlines. They don't suddenly tighten their underwriting criteria just because a talking head on TV predicts a recession.
They let the data do the talking.
Right. They let the cold, empirical math of consumer repayment patterns dictate their strategy. And what the Upstart Macro Index shows is that consumer behavior, their actual ability and willingness to service their debt, has remained locked in a very narrow, predictable range.
The data cuts through the drama.
It really does. And there was a remarkably candid moment from management regarding this. They pointed out that their business model does not require the economy to boom. They don't need GDP growth to break records.
What do they need?
Mere stability is all their AI needs to thrive.
Wow.
As long as the consumer remains in that stable, predictable band, the AI can price the risk accurately. If the risk is priced accurately, the loans outperform treasury spreads. If the loans outperform, the institutional capital keeps flowing. Stability is literally the only fuel the engine requires.
That is a profoundly different way to view the economy. We are so conditioned to look for booms and busts, But underneath the chaotic noise of the daily news cycle, the mathematical reality of the everyday consumer is just quietly steady.
It's a comforting thought, honestly.
It really is. So let's pull all these threads together. We started this deep dive looking at a massive financial contradiction. A company aggressively growing its core product by 60%, boosting revenue by 40%, yet reporting a drop in profitability.
Yep.
And we discovered this wasn't some operational failure, but a deliberate, mathematically driven reinvestment strategy. They're absorbing seasonal expenses and willingly sacrificing Q1 margins to capture highly valuable market share for the future.
And we saw that future taking shape with the launch of Cashline, which is a really strategic pivot into the massive daily engagement world of revolving credit. It's a product designed to let the AI prove its risk modeling at scale before bringing in institutional money to fuel it.
Right. And we uncovered their defensive moat, securing $4 billion in capacity and locking in those 24-month committed capital deals to effectively insulate the company from external market shocks.
And finally, we saw that their entire aggressive growth posture is validated not by Wall Street sentiment, but by the objective high-frequency data of the Upstart Macro Index, confirming the resilience of the everyday borrower.
For you listening, the core takeaway here applies far beyond the fintech sector. True, compounding long-term growth almost always requires the discipline to ignore short-term optics.
So true.
Whether it's a massive tech platform absorbing an expense spike to build a revolutionary new product, or you personally taking a temporary financial step back to pivot into a higher growth career, the math of capital-efficient reinvestment works, provided your foundational data is sound.
I want to leave you with one final thought to ponder, building on that divergence we discussed at the end.
Okay.
We've seen how a private company's model-first AI can accurately predict consumer stability by basically ignoring panic-inducing headlines and analyzing millions of high-frequency, real-time financial variables, right?
Right.
It raises a fascinating question about the future of our broader financial system. As these corporate AI models become more sophisticated, and frankly, more accurate than anything the public sector possesses, how long will it be until we start using proprietary tools like the Upstart Macro Index to drive our national economic policy,
Oh, wow.
instead of continuing to steer the global economy using the slow, lagging, and heavily revised government indicators of the 20th century?
That is an incredible point. From decoding the hidden mechanics of a single earnings call to fundamentally rethinking how we measure the pulse of the entire global economy. It all comes back to having the discipline to look past the current quarter. The bottom line might look a little lighter today because of the structural investments being made, but if the foundation is built on superior, real-time data, the compounding returns of tomorrow are nearly unstoppable. Thanks for diving deep with us.